Hi, I'm Nathanael Gandhi, and welcome to my financial presentation, where I discuss how Coles Group have structured themselves financially in comparison to Woolworths Group. To understand the financial situation of both Coles Group and Woolworths Group, who are major competitors and hold a majority market share of grocery retailing in Australia, we need to look at their individual business positions and strategies. Coles holds 27.6% of the Australian grocery market, with Woolworths Group holding 34% as of 2018. In 2018, Coles Group demerged from Wesfarmers Limited, and as such have taken the strategy of divesting themselves of most of the businesses that are not directly related to their core of grocery retailing, such as Kmart, Target, and Officeworks. Woolworths Group have taken the strategy of holding on to all their subsidiary businesses, such as Big W. Additional to this, Coles Group do not operate overseas, unlike Woolworths Group, who also operate grocery retailing in New Zealand. This is reflected in each of the company's revenue streams, and form the two different strategies with financial implications for both companies. Looking at their market value, calculated by using the formula for market capitalization, one can see that Coles Group have started the financial year of 2019-2020 with $17.4 billion, compared to Woolworths Group of $41.6 billion. It is worth noting that because market capitalization relies on investor confidence, it is potentially volatile and unreliable measure of a company's true value. Many factors go into determining the share price of stock, so it's best to take this figure with a grain of salt. It does, however, lean towards the size of the overall company. Looking at their assets breakdown, you can see that Coles Group have fewer assets than Woolworths Group, and generally are a smaller sized company. The makeup of these assets, however, differs greatly between the two companies. Woolworths Group fund their assets through approximately equal measures of liabilities and equity. On the other hand, Coles Group rely more on debt and other provisions to fund their assets, with an approximate ratio of 2/3 liabilities to 1/3 equity. Their size difference typically impacts the buying power of each company, and in turn impacts the cost of goods. The larger Woolworths Group can source stock at a greater discount, thereby increasing their gross profit margin. This is reflected with Coles Group having a gross profit margin of 23.9%, which is 17.9% less than that achieved by Woolworths Group, with their stronger buying power and size. To remain competitive, Coles Group are focused on managing their fixed expenses more effectively than Woolworths Group, which they are able to do because of their less extensive footprint. Hence, Coles Group managed to achieve an operating profit margin of 3.8%, which is comparable with that of Woolworths Group at 3.9%. This is further backed up by looking at their expenses. The cost of sales for Coles Group makes up 77.4% of their expenses, compared to Woolworths Group at 72.5%. One of the reasons Coles Group are better at controlling their overheads may be due to their size in comparison to Woolworths Group, as overheads are typically harder to manage in larger organisations. Since Coles Group have divested themselves of previous businesses, they've been able to inject a lot more cash into their business than Woolworths Group comparably, which is reflected by their higher cash ratio of 0.15, demonstrating higher liquidity. Coles Group are more highly leveraged than Woolworths Group, with a debt ratio of 0.15 compared to 0.13. Obviously, this is a riskier strategy, since Coles Group are more exposed to both market risk, such as economic turndowns, and interest rate risk. In the current low interest rate environment, this risk makes good business sense. Retailing is a cash flow positive business due to high volumes and high turnover of stock. Net cash provided by operating activities has greater benefit for Coles Group than for Woolworths Group, 2.3 billion versus 2.9 billion, even though Woolworths Group is twice the size of Coles Group. Since Coles Group is primarily focused on grocery retailing, they have used their superior cash flow and cash reserves, 9.6% of assets, compared to 4.5% of assets for Woolworths Group, to leverage more. In summary, Coles Group's strategy of divestment and focus on core business has enabled them to manage fixed costs more efficiently than Woolworths Group. However, Woolworths Group have used their market dominance and size to achieve superior gross operating margins. The differing strategic business approaches taken by these companies is reflected in their different financial structures. References have been included in the submitted slides, along with additional information about two key investments I know you will find quite interesting. Thank you very much for your attention. I'm Nathanael Gandhi, and happy to answer any questions you may have.